Welcome to the deep dive. We're aiming to cut through the noise today and get straight to the insights on something pretty significant that just happened. We're tracing these, well, invisible threats, connecting that U.S. precision airstrike on Iran's nuclear sites all the way to, the gas prices you see and maybe even the stability of your own investments. We've got this key analysis right here. It's titled Iranian Strike, Market Reactions and Policy Responses. And we've really been digging into it to pull out what actually matters for you. So our mission today, it's really to understand not just what happened in global markets right after the strike, but maybe why the reactions were, well, let's say, nuanced this time around. We also want to look at what investors are actually doing right now and crucially what steps might be planned to prevent, a bigger global shock. Okay, let's peel back the layers on this one.
Absolutely. And I think it's vital to stress right from the start that while the market responses were definitely immediate, the source actually describes them as measured, not panicked. The key takeaway for now seems to be that markets are certainly, pricing in that geopolitical risk premium, and they're anticipating some energy-driven inflation. But the really big shifts, they depend entirely on whether we see more escalation or, and this is the big one, a closure of the Strait of Hormuz.
That measured reaction is really interesting, isn't it? Especially given how serious the event itself was. So let's dive into those immediate market signals. Our source mentions this broad defensive repositioning by investors. What specific signs popped up right after the strike that kind of show us this shift?
Yeah, we saw some really clear signals. First, a definite flight to safety, the usual suspect, U.S. Treasuries. At the same time, oil futures spiked pretty dramatically, and commodity markets got, well, quite volatile. Gold rallied significantly, as you might expect. But industrial metals, they were sending more mixed signals.
Okay, understood. Treasuries, oil spike, gold up, other commodities mixed. But why cautious, not panicked? You mentioned those crucial variables. What are they, again, that could really flip the switch from just caution to, well, something worse?
Right, the caution really comes from the fact that, okay, a major event happened, but the direct economic fallout isn't, let's say, catastrophic yet. The crucial variables are really twofold. First, how much further does this escalate, especially if it involves direct military confrontation? And second, that potential disruption or outright closure of the Strait of Hormuz. Those two things, if they happen, those are the real game changers for global markets.
Okay, let's really drill down then, starting with that ultimate safe haven, usually the U.S. Treasury market. How exactly did it react right after the strike?
Well, the 10-year Treasury yield, it dropped. Went down to 4.38% from 4.46% right after the strike. That shows that classic safe haven demand. We also saw the iShares TLT ETF, the one tracking long-term bonds. It stabilized around $86.49. That suggests some moderate inflows into bonds. And interestingly, there's a noticeable jump in demand for shorter-term stuff, too. 3-month and 6-month bills. Their yields fell about 10 basis points within 48 hours.
Okay, so definitely a flight to safety, but the source calls it modest. That seems subtle. For the bond market in a crisis like this, I might have expected something more dramatic. What was holding it back?
Yeah, and what's fascinating here is this kind of counteracting force. So yes, investors wanted safety in treasuries. But at the exact same time, those spiking oil prices immediately stoked fears about inflation staying high or even rising more. And that inflation worry, it basically acted like a brake. It prevented yields from falling much further. It tempered what might otherwise have been a really classic full-scale bond rally you'd see in a crisis. It's a genuine tug of war.
Ah, that makes perfect sense. That complexity explains the modest reaction. Okay, so with bonds showing that sort of push-pull, let's pivot to oil. That's often the first domino, isn't it? What was the immediate hit there?
Well, oil markets saw a very sharp repricing, almost instantly. Brent crude, it spiked 4.2%, up to $89.50 a barrel. And WTI crude, that was up 3.7%, hitting $84.70. And looking out further, futures contracts for, say, the third quarter of 2025, they're now pricing in these significant risk premiums. We're talking $4 to $6 per barrel, higher than before the strike.
$4 to $6 extra, just on risk. And what are the sort of strategic fears driving that? It's not just about current supply, is it? It's what might happen.
Exactly right. The absolute dominant fear is potential disruption to the Strait of Hormuz. Roughly 20% of all global oil passes through that narrow channel. So the market's basically holding its breath, playing this high-stakes what-if game. And this isn't just theory. We saw insurance costs for oil tankers surge, like 25%, especially for ships near Bandar Abbas and Fujairah, right in that zone. Plus, there's all the speculation swirling about possible retaliatory drone attacks, maybe on Saudi or UAE infrastructure. That's definitely feeding the volatility in the futures market.
Wow, okay. So it's both the immediate price jump and this very real fear baked into future prices. Beyond oil, then, what about other key commodities? Was it just a general risk-off move, or did things get more specific?
Oh, definitely more specific. It was a really mixed bag, actually. It shows how individual logistics and demand factors really matter. Take agricultural commodities. Wheat futures, they rose 2.1%. That was linked to fears about shipping disruptions, especially through the Red Sea. Corn futures were up too, about 1.5%, mostly due to broader uncertainty about Middle East logistics chains. But then you look at rice futures, they stayed pretty stable. They're just less reliant on those specific Mideast shipping routes.
Interesting. So even within agriculture, different stories. What about industrials?
Industrials were split too. Copper actually dropped 1.2%. That seems like a combination of general risk-off sentiment and those ongoing worries about China's economy slowing down. But aluminum, it rose 0.8%. The thinking there is potential sanctions on Iranian bauxite, which is used to make aluminum. Steel futures, though, they were basically flat. Just reflects the sluggish global demand for steel right now.
Okay, and precious metals. That's usually where you look in times like these.
Exactly. And they did what you'd expect. Gold saw a really significant rally, up 5.6% to $2,421 an ounce. That's your classic geopolitical hedge right there. Silver also rose 3.4%. It often shows a mix of, risk-on industrial demand and risk-off safe haven appeal.
Yeah.
And platinum was up 1.7%. That seems linked to worries about production stability, not just in Iran, but maybe spilling over into Africa too.
Right, so it's clear that even though the trigger event was the same, each commodity really reacted based on its own specific supply chain and demand story. What does that tell us about how the market differentiates risk? And maybe more broadly, how did all this feed into currencies and stock markets? Because that affects, well, almost everyone's portfolio.
Yeah, good question. In the currency markets, the U.S. dollar index, the DXY, climbed 0.9%. Pretty clear flight to dollar safety there. The euro and the British pound, they weakened a bit against the dollar. The Japanese yen saw a very brief jump as a safe haven, but then it kind of moderated. But the really dramatic move was the Iranian rial. In unofficial markets, it plunged around 12% within just 24 hours of the strike. Huge hit.
Wow, 12%. Okay. And equities, stock markets.
Equities took an immediate hit pretty much across the board. The S&P 500 was down 1.2%, NASDAQ fell 1.6%. Closer to the region, the Tel Aviv Stock Exchange dropped 3.4%. And broader emerging markets, tracked by the MSCI index, are down 2.1%. But if we connect this to the bigger picture, you could really see the differentiation between sectors. Airlines, shipping companies, semiconductor stocks that got hit hardest. That's classic risk-off sentiment, plus worries about supply chains and costs. But on the flip side, defense contractors, oil and gas companies, and precious metals miners, they actually saw gains. Shows exactly where money flows when geopolitical risk spikes.
That sector rotation really paints a clear picture of investor thinking, doesn't it? Where the perceived risks and opportunities lie. Okay, so this brings up a really important question. We've talked about the immediate reaction, but looking ahead, what's next? What are the experts, according to this source, seeing as potential futures, and what are they recommending?
Right. The source lays out 3 key scenarios, and importantly, assigns probabilities to them. The most likely scenario, they give it a 60% probability, is basically that the status quo holds. No closure of the Strait of Hormuz. In that case, oil probably stabilizes, maybe in the $85 to $90 range. Bonds stay kind of flat. Gold consolidates its gains. Then there's a 30% probability assigned to Iran retaliating, but indirectly, using proxies like Hezbollah or the Houthis. That would likely see oil spike above $95, maybe gold pushes past $2,500 an ounce, and bond yields would likely dip further on increased fear. And the least likely but most severe scenario, given a 10% probability, is actual disruption or closure of the Strait of Hormuz. That would be huge. Oil likely surging above $110 a barrel, Treasury yields collapsing as investors scramble for safety, and global stock markets potentially falling 5 to 10%.
Those are some starkly different paths ahead. Given that range of possibilities, what specific policy actions are being recommended? How should authorities prepare?
Well, the recommendations cover several areas. For the U.S. Treasury and the Federal Reserve, the advice is to monitor that oil-driven inflation very closely. They might need to delay planned interest rate cuts if inflation stays high or picks up. And they need to be ready to provide liquidity to bond markets if volatility really spikes. Then there's the Strategic Petroleum Reserve, the SPR, America's Emergency Oil Stash. The recommendation is to have a plan ready to release maybe 30 to 60 million barrels if Brent crude goes over $100. And importantly, to coordinate that release with the International Energy Agency, the IEA, for a synchronized global response if Hormuz is threatened.
Okay, so managing inflation, ensuring market liquidity, and having oil reserves ready. What else?
There's a focus on financial stability, too. The Financial Stability Oversight Council, or FSOC, is urged to keep a close eye on derivative exposures, especially in key commodities like oil and gold. They might need to issue guidance to big players like hedge funds and trading houses about handling margin calls and sudden volatility spikes. And finally, there's a crucial piece about coordination between the Department of Defense and the Treasury. Two key things: pre-planning insurance backstops for commercial ships going through Hormuz to keep trade flowing if possible. And secondly, being ready to immediately identify and slap sanctions on any Iran-aligned traders, insurers, or metal exporters involved in facilitating problematic activities.
Right. So it's a multi-pronged approach: monetary policy, energy reserves, financial oversight, and targeted sanctions plus logistical support.
Exactly. So if we sort of boil down the core conclusion from our source, the U.S. action against Iran's nuclear sites hasn't, completely destabilized global markets yet. But as the saying goes, the fuses are lit. You see it in the bond market's measured reaction, but more clearly in oil and gold, which have already priced in a pretty significant risk of escalation.
Yeah, and as we've kind of circled back to a few times, that key variable really seems to be Iran's next move, whether that's direct confrontation, which seems less likely maybe, or that indirect asymmetric warfare approach.
That's right. And the source really emphasizes this point. The window for economic containment and market stabilization is open right now, but it might not stay open for long. That's why this rapid response planning across energy, finance, and defense policy needs to happen now. The goal is crystal clear: avoid repeating a kind of 1970s-style energy shock to the global economy.
That's definitely a powerful thought to end on, and maybe something for you, the listener, to consider. Think about how just one single geopolitical event happening potentially far away can set off this incredibly complex chain reaction. It ripples right across global financial markets, impacting everything from, yes, the cost of your commute to the stability of your savings and investments. How does watching this intricate dance between geopolitics and economics make you think about how information flows and how decisions get made in this incredibly connected world we live in? Something to ponder.